We've all heard about saving for a rainy day, right? But what if I told you that safety net could be doing so much more for you? Today, we are going to completely rethink the emergency fund. We're going to transform it from just a pile of cash sitting on the sidelines into a really powerful financial tool that not only protects you, but actually grows your wealth. So let me ask you a question right off the bat. You've done the smart thing, you've stashed money away for emergencies. But is that safe money just sitting there, silently getting eaten away by inflation? It's time to challenge that old way of thinking, because your safety net should be working smarter for you, not just harder.
So let's be crystal clear about what we're talking about. An emergency fund. Think of it as your financial airbag. It's not for a vacation, it's not for a new gadget. It's a dedicated cash reserve that's designed to inflate instantly when you need it most, protecting you from the financial shock of a sudden job loss, a medical crisis, or a major home repair.
But why is this so critical? Well, because being unprepared for one of those financial shocks isn't just an inconvenience. It can be absolutely catastrophic for your long-term wealth. Let's really look at what happens when that airbag isn't there or it fails to deploy. It sets off this devastating domino effect. First, you could be forced to sell your investments right when the market is at its lowest point, locking in those losses forever. Then you might have to rack up high-interest credit card debt, which is just incredibly hard to climb out of. And even worse, you might have to raid your retirement accounts, which not only triggers taxes and penalties, but, and this is the real killer, it destroys decades of potential compound growth. And look, this isn't just my opinion. Research from financial giants like Schwab and Vanguard backs this up completely. Having that liquid cash buffer is the key difference between just weathering a financial storm and having your entire financial ship go under. It's what allows your real long-term investments to keep growing, completely uninterrupted. Okay, so we've covered the why. Now let's get into the fun part, the how. We're going to build your modern toolkit right now by answering the two most important questions. Exactly how much money do you need? And where on earth should you put it to maximize both safety and growth? The classic rule of thumb is honestly a great place to start. Aim to save up 3 to 6 months of your essential living expenses. And when I say essential, I mean the absolute must-pays. Your mortgage or rent, your utilities, groceries, minimum debt payments. You got to cut out all the extras for this calculation. Now, if you're a freelancer or you work in an industry that's kind of up and down, you'll want to aim closer to 6 or maybe even 12 months for that extra peace of mind.
Now, where you park this cash makes a huge difference. For years, the default was just a traditional savings account at your local bank, earning, well, next to nothing. The current national average is a measly 0.61%. But just look at that compared to a high-yield savings account, an HYSA, which can offer upwards of 4 or even 5%. The choice here is pretty stark, wouldn't you say?
Let's put some real numbers to that. On a $30,000 emergency fund, the difference between those two accounts is over $1,000 in earnings every single year. By choosing the wrong account, you are literally giving away free money. This is the hidden cost of just letting your money sit in the wrong place. I mean, this visual makes it pretty obvious, right? Both high-yield savings accounts and money market accounts, which are a lot like savings accounts but sometimes let you write checks, they just dramatically outperform the old-school options. And crucially, both of them are safe, they're liquid, and they're FDIC insured up to $250,000. This really should be the new baseline for your emergency cash.
Okay, so we've established that high-yield savings accounts are the new baseline. But if you want to take it to the next level, we can use what's called a tiered strategy. This is a more advanced approach that perfectly balances your need for immediate cash with a chance to earn an even higher yield, all while keeping your money totally safe.
So here's how it works. You split your fund into 3 tiers. Tier 1 is your super liquid cash, about 1 to 2 months worth of expenses, and you keep that in a high-yield savings account for instant access. Tier 2 holds the next 2 to 4 months of expenses in a money market fund, which often gives you a slightly better rate. Then for Tier 3, your extended safety net, you can use things like short-term T-bills, which are basically just super safe loans to the US government, or laddered CDs to lock in even higher rates. This layered approach also gives you this huge psychological benefit. It creates these mental firewalls that make you way less likely to panic and sell your long-term investments. So what's the real payoff for this extra effort? Well, it's not small. That same $30,000 fund, when it's optimized like this, could generate over $6,500 in pre-tax growth over just 5 years. That's thousands of dollars in free money, your safe money earned for you, just by being in the right places. Feeling motivated? Good, because knowledge is only powerful when you actually act on it. So here it is, a simple 5-step action plan to put this entire strategy into motion, starting today.
The blueprint is really straightforward. First, calculate your specific target number. Second, open the right accounts. A high-yield savings account is the perfect place to start. Third, automate your transfers. This is key. Let your savings grow without you even thinking about it. Fourth, just check in every quarter or so to make sure your rates are still competitive. And finally, once that fund is full, you can start investing any excess cash for some serious long-term growth. Now, as you put this plan into action, please be aware of these common traps. The biggest mistake, by far, is leaving your cash in a checking account where inflation just eats it for lunch. But the opposite is also really dangerous. Don't put this money into volatile stuff like stocks or crypto. Remember, this is your safety net. It is not a lottery ticket. Also, keep an eye on those FDIC limits, and of course, avoid any of those shady, too-good-to-be-true investment schemes. So let's bring this all together. Building an optimized emergency fund isn't just a defensive move against what could go wrong. It's actually an offensive move. It's about empowerment. It's the solid foundation that gives you the confidence to take smart, calculated risks in the rest of your financial life. And you know, while we've talked a lot about percentages and dollar amounts, the true return on this strategy, you just can't measure it on a spreadsheet. The return you get from peace of mind, from sleeping well at night, and from the losses you avoid by not having to panic sell your investments, that is truly priceless. I'll leave you with this final thought to really chew on. Just imagine your financial future for a second. What could you truly achieve if the fear of a short-term market downturn was no longer a major factor in your decisions? With a proper safety net in place, you're free to invest for the long term with confidence and with conviction. That is the real power of a modern emergency fund.